Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The main pattern here since September 2024 had been, I suppose still is, after a fashion of sorts, is the breached and seemingly repaired dark blue September to December 2024 bear channel, currently 1457 to 1818. However, since February, the bright pink late September 24 to mid-January 2025 bearish Andrews pitchfork, which I drew 18 weeks ago, is a better contender in showing the bearish angle of attack. And on this one, we are today in between the middle time below, currently at 1468, and the upper time above, currently at 1724. Then, in the more immediate past, between mid-May to early July, we have had a small bear channel, which had been quite good at showing the very recent bearish incentive of the market, which saw prices punch higher and out of it after a forced break lower 2 weeks ago. I will discuss this in more detail shortly. The reason being is that there is also another larger pattern complementing the other bearish patterns, a longer term bright red November 23 to September 24 bearish shift pitchfork, which has been also been pretty good at showing the bearish angle attack over a longer time frame. On this one, we are today just above the bright red middle channel, actually just below it. And that's currently at 1644 and just below the green declining short medium moving average, currently at 1682. This bright red middle tine along with the bright pink middle tine had between them helped hold up the market on a number of past occasions, even though they are bearish patterns. Going back to the more most recent immediate action, where the a really strong drop down 2 Mondays ago below the pink middle tine and the dark blue lower trend line, though no doubt they eroded the bearish incentive on that move. But it was the March 2021 low at 1467 that finally halted the decline and turned prices higher, eventually pushing up and out of the bear channel. In the process of doing this, the market created a weekly key reversal up 2 weeks ago, the first weekly key reversal up since at least 2018. Thus, prices are up and challenging the bright red middle tine right now, and maybe even the green short medium moving average at some point, and possibly even the bright pink upper tine. So, is this a long anticipated by some bullish turn higher from all the bearishness we've seen since late February? At the moment, I'd say no. It is a recovery, a small one so far, from a massively overt bearish market. And the weekly key reversal up 2 weeks ago is an interesting indicator to start watching out for signs that this may be more than just that. But for now, it is a pullback in an otherwise still bearish market. We need much more than what we've seen so far to justify such a change in the market's aspect. Iced Europe white sugar in London. After all this time, there still continues to be 3 features of this market to bear in mind on this daily chart. The first of the 3 patterns is the obvious and broken, though now back to being repaired, if only just. Purple late September 24 to mid-February 25 descending expanding wedge pattern, currently 487.80 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ necessary touches made by January this year, and had been severely tested on the top side between late February to mid-April, enough that I would not necessarily classify it as a descending wedge pattern after February, though I'm still keeping an eye on the extension to the upper trend line, as I believe it to be significant. After the break higher seen between February and March, on the way lower, I asked you 13 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market started utilizing the bright pink middle tine first as an attractor, riding prices lower in a shallow glide until 7 weeks ago when the market broke free on the downside, but still riding near to the middle tine. Last week, and for a shorter time during the week before, we saw attempts higher that so far have seemingly failed, getting caught up in the well-highlighted overhead congestion between 489 even and 490.10. Now this is a narrow band that had previously been breached and now acts as a resistance. The band itself consists of the April 2017 high at 489.10, plus congestion from late 2021 to early 2022, including a quad bottom back then, along with the bright green neckline extension to the April to June 2021 head and shoulders top, currently at 491.70, which is a little higher up. The result of all this was an outside week 2 weeks ago, not as powerful as the weekly key reversal up seen in New York sugar, or indeed seen here 4 weeks ago, but these are still there nevertheless. What it seems to come down to now is whether the market has the bullish incentive to push up over the middle time, the purple upper trend line, and the bright green neckline extension. Right now, it doesn't look like it might. However, there is still one setup for an incomplete pattern. We are set up with less than half the month of July gone by for a potential monthly key reversal for July. Thus, if we close on the 31st of July either over 476.10 or under 472.9, then we're on. Anything in between will have a lesser outside month pattern. Right now we are tinkering with a possible outside month pattern, though possibly only just. Sugar white premium spread. Some interesting recent gyrations here. 13 weeks ago we had a weekly key reversal down as the market made a new peak at the time, but prices pulled back down as well with a weekly key reversal down at the same time. And we continued lower until the combined bull hammer pattern and bullish engulfing pattern 6 weeks ago. Prices had closed fully below the declining gold long moving average, currently at 101, and this full move below the gold long moving average seems to have prompted the move back up. Plus, it was also a third touch and pull back up from the dark blue November 24 to date uptrend, currently at 105 3/4. The pullback up turned into a fresh move higher through the twin pair of overhead 50% Fibonacci lines at 128 3/4 and 131 1/4 for the July 19 to September 22 move and the August 21 to September 22 move, respectively, and congestion at 134 1/4 and into a fairly free area overhead, which it duly exploited 2 weeks ago, but it ran into the significant 2013 high at 152 3/4 and swiftly turned back down, just as it did back in mid-April, and made a combined weekly key reversal down and bearish engulfing pattern 2 weeks ago. Last week was very indecisive, a long-legged indecisive doji cross, but this week we are testing lower, down towards the dark blue uptrend once again. Now you could have an argument that the whole action from April and possibly even from November last year could be a possible bull channel, a quite wide one, and I would see your point. However, I'm not ready, not just yet, to call it so. At least not just yet, though I may change my mind next week. Indeed, I'm more inclined to look at the whole January to early June action as part of a possible bullish shift pitchfork when I've drawn on my daily chart, but as yet not highlighted. It all depends if the dark blue uptrend holds or not.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.